Good day, students. I will be doing exercise 10.4 with you in the topic of contract costing. So now this is contract costing and it is chapter 10 of your textbook. 10.4 says on the 1st of September in the year 2003, Odrikoto Builders Ltd started work on a contract for Kadima Shop Close Corporation. In terms of the contract, the work had to be completed within 12 months. That means only 1 year. And the contract price agreed upon was 190,000 rands. So now this is the price of the contract. And it continues by saying that machinery which was brought on the 1st of September 2003 for 400,000 rands has been used exclusively for this contract. The expected life of the machinery was estimated as 5 years, after which it would have a terminal value of 100,000, which is the scrap value or residual value. A telephone was installed on the premises and has been used exclusively for this contract. The telephone cost to date amounts to 4,700. So now this is the cost of the telephone, which we already know that it will be recorded on the debit side of the contract price. Odrikoto Builders appointed Speedy Electricians as subcontractors to do the electrical installation, and their cost to date is 64,800. So now this is the cost of the contractors that will be recorded on the debit side of the contract account, and that will be recorded as Speedy Electricians. Other transactions are as follows, or as shown below. Material was purchased from the warehouse and delivered to the site. So this is the material issued from the storage. So now this was the storage that is within the site. This was straight from the warehouse of this business, but this was within the storage that is, I think, will be in the site. Then material was returned to the storage, and this was the return of the material, and they list all the entries. Let me just go straight to the requirements so that we know what we are required to do. It says draw up the contract account with Kadima Shops Close Corporation as it would appear in the ledger account. So now we are doing the contract account for Odrikoto Builders Ltd. And it further says clearly indicate the profit or loss on the contract account on February 2004, as well as the balance sheet entries on the same date. So now we also have to do the extract of the statement of financial position for entries that will affect that statement. So now let us do the contract account, which is contract account for Kadima Close Corporation. So now this is a ledger account, and we write contract account, and the contract account is for Kadima Shops Close Corporation, and this is the ledger account for this business. They are doing the ledger account by the end of the period. So now we'll record everything that has to do with this contract. So now we know that all the expenses are recorded on the debit side of this ledger account, and whenever there's a transfer of material back to the storage or is transferred to another contract, it has to be recorded on the credit side of this contract. So now we start from the beginning, where we are told that the contract price for this contract was 910,000 rands. That does not get to be recorded in this case. Then let us continue. And then it said that there was machinery that was brought on the 1st of September for 400,000 rands and has exclusively been used for this contract. So now let us record that machinery on the debit side and we say machinery. So now we record all the expenses that are incurred for the contract, and the machine was valued at 400,000 rands. So now after we've recorded the value of the machine, then we check for other expenses. Now we are told that this machine was exclusively used for this contract. So now if it was exclusively used for this contract, it will mean that we have to take into account depreciation for the period. And remember, this was there from the 1st of September, and we are doing the contract account on the end of September, 28th of September, 29th of February in the year 2004. So now it means we have to count from September, October, November, December, January, February. Therefore now depreciation for this plant will be accounted for 6 months, but we'll do that a little bit later. Then after it further said that the expected lifespan, then we are given the useful life, we are given the residual value of 100,000 rands. And now we have to record the next expense, which is the telephone account, where we are told that the telephone was installed and the telephone cost to date amounted to 4,700. So now we have to record the telephone because this is an expense that had to do with this contract. So now telephone will be 4,700 rands. Then we check for the next expense, which is the hiring, and that hiring was the hiring of the subcontractor, and subcontractor was hired at the value of 68,400 rands. So now it said that Odd Decoto Builders appointed Speedy Electricians as a subcontractor to do the electrical installation, and the cost to date is 64,800. So now that is the cost of the subcontractor that we have to record. So we record that as Speedy Electricians. We record the name of the company that was doing the electricity, Speedy Electricians. And Speedy Electricians costed us 64,800 rand. This was the cost that we incurred for this contract. So now we have to record that cost too. Then after now we have other costs that were incurred in terms of the material, and the material was from the wholesaler, and it amounted to 237,320. And we don't know either was it cash or it was credit, but we just have to say wholesaler because it was from the wholesaler. So we just say wholesaler, and we record wholesaler close corporation. We record 237,320. So now that is the material that was bought from or transferred from the wholesaler, purchased from the wholesaler. So now the next entry was the material that was issued from the storage. So now that will be from the material control. Obviously, if you are familiar with chapter 8 and chapter 9, if we transfer material from the material control, then we record material control. So now this is material from the storeroom, material control, and this is 54,100. This was the purchase of the material. So now we assume that this entry, the previous entry, this entry, we under the assumption that the purchase of this material was on credit. So now that is why we write the name of the creditor to indicate that it was on credit. If it was bought for cash and it was stated, then we're going to record the bank. But we're just under the assumption that it was bought on credit if they are silent. Then now we continue on that same note. We have material that was returned to the storage. Remember, this was from the storage, this is to the storage. So now we are taking material from the contract and we are transferring it back to the storage. So now that means our contract account will decrease by the cost of the material that was transferred. So now we have to credit material control, and we say material control, and we record 3,230. That will be material control. Then after we continue with that same note, it says material transferred to contract C501. So now there was material that was taken from this contract and it was transferred to another contract. That means now obviously we are reducing the material that we have on the debit side, because this is material that was bought and this was material that was transferred. And all these two materials, they are in this contract now. We are busy working with these materials. And now because of the need of some material from another contract, then we transfer some material from this material obviously. And if we take material from here and we transfer, it should be recorded on the credit side to indicate that we are taking material out of this contract and we are transferring it to another contract. So now that is why it will be credited, and the contra entry will be contract C501, contract C501, and we record that as 5,590 rands. Then we continue on that same note. Then we say, okay, the next entry says that overheads absorbed. It says overheads absorbed at 25% of the cost of the material used. So now we need to know the material that was used, and we multiply this by 25%. But we need to know what was purchased, of which we know the purchase, and we know the transfer, we know the transfer, we know the transfer, which it will be minus and minus. But we don't know how much value of the material was left in the contract. So now we first have to read all the entries. Then when we know the value of the material that was left at the end of this period by the 29th of February, then we can be able to calculate the material that was used, so that we multiply that by 25%. So now this is still a question mark, and also the depreciation here is still a question mark. We'll have to come back and complete these entries whenever such time arrives. Then it says that rent paid on equipment is 9,500. This is the cost that we have incurred for the equipment. We could have hired an equipment or rent an equipment for 9,500, and it is for this contract. So now the rent paid will have to be recorded on the debit side. Rent paid, and this rent is paid on equipment. So now we record this as an expense for this contract, and this rent is 9,500 rands, and we record that on the debit side because it's the cost that is incurred for the contract. Then after we have the work that was certified by the architects at the sales value of 630,000 rands. This is the money that we're supposed to receive from the client. And it says after that the amount received from the client, which is Katima Shops Close Corporation, amounted to 560,000 rands. So now in this case we receive an amount that is less than what we're supposed to receive, meaning now that the difference will be the retention amount. We're supposed to receive 630,000 rands, but we only received 560,000 rands. Then it means now 70,000 will be a debtor by the end of this period, which is the 28th of February 2004. So now we'll also do that when we deal with the ledger account. We'll deal with that and we'll deal with that. We need this in the contract account, and this will be recorded in the debtors account because our client is a debtor to us. So now when we do the debtors account, which is the account of the client, then we'll record the cash that was received from the client to determine the amount that the debtor still owes us or the client still owes us, which is called a retention amount. Because the retention amount, the amount that the client withheld because of some emergency, in case maybe there is unsatisfactory in terms of the quality of the work that we have done for the client, then the client will be able to say, please complete this work because you still owe me, because the client still has money on his side. Then now it further says that wages paid by check amounted to 74,000 rands, and this is the expense for this contract, wage control. Contra entry will be wages control, and you are familiar with that, and it comes from chapter 8 and chapter 9. So wages for this period amounted to 74,000 rands. Then after we have another entry where it says tools purchased and paid by check, 16,000 rands. So now we bought tools, and these tools, they amounted to 16,000 rands. Remember, the tools are bought for this contract. So now we have to say bank because we know that these tools were bought for cash. Then after, in brackets, we write always things in details. Tools purchased. When it comes to contract, we write things in details, and that will be 16,000 rands. It will be 16,000 rands. Then after, now we check if do we still have any other expense that we have to account for. Then we check if is there any other. Okay, yes, there is another entry that we still have to record. It says surplus tools sold for cash. The cost price of these tools was 2,000 and the selling price of these tools was 2,300. Remember, in the contract costing, we don't record the accidental profit. We only record the profit for the contract. When I'm saying accidental profit, I'm referring to the profit that you get on the disposal of the equipment or the disposal of the tools in this case. If you make a profit on such sales, we don't record the profit in the contract costing, but we record, or we do recognize the cost or the equipment or the tools that were sold at the cost price, meaning that the tools will be recorded at 2,000 rands, not at 2,300. But when we do the income statement, then the difference between the two might be recorded as a profit which was made on the disposal of the tools. We are not in business to sell tools, but sometimes in the contract costing, we do sell some items. So now the tools will be recorded at the cost price, not at the selling price. Why that is the case is because when we bought tools, we recorded the tools on the debit side, and those tools amounted to 16,000 rands. And this was the cost price of the tools. So now when we de-recognize these tools, they must be de-recognized at the cost price on the credit side. So now that is why we'll have to say bank on the credit side, because we received cash, and that will be 2,000 rands. Therefore, now in brackets, you can say tools sold. Tools sold, where we have sold tools. Then now we go to the next entries where we are given the closing balances. The next entry says balances on the 29th of February 2004. These are the balances that appears at the end of the period. We are given the material on hand, and the material that is on hand, it is 7,000 rands. So now meaning that after we bought material of this amount, which is the material of 237,000, and there was also another material transferred, and after we have transferred this back, and after we have sold or transferred this to another contract. So now after all this has been taken into account, there was still material that was left on the site for this contract. So now that material which was left is the one that they tell us that it is costing or worth an amount of 7,000 rands. And here is this material, the closing balance by the end of the period, which is the value of the material by the end of the accounting period. So now we have to record all these as balances. Then we have to say balance. We record balance, and this will be balance carry down, balance carry down in terms of material, balance carry down in terms of material. So now we record that balance in terms of material as a balance carry down, and the balance carry down is for material, and that material was worth 7,000. Then we're also given or told that there was a balance also at the end of this period, and the balance at the end of this period is the balance for the machinery. They say balance on machinery on hand on site is a question mark. They don't tell us the value of the machinery at the end of the period. Remember, in terms of the machinery, we are looking at what is called the carrying value. In terms of the machinery, we are looking at the carrying value. This is CV. So now it means we need to say cost less accumulated depreciation, and this will give us the value of the material at the end of the period, which is the carrying value. So now let us do the calculations for the machinery which is on hand. The carrying value for the machinery which is on hand. So now we go to that calculations while I'm still waiting for this. So we first have to calculate the depreciation on the machinery. Depreciation on machine, and we need to know the cost less residual value, and the cost of the machine was 400,000, and the residual value is 100,000. Then this will give us the depreciable amount of 200,000, and we divide by 5 years, and when we divide by 5 years, we will see 300,000 divide by 5, that will give us 60,000. This will be 60,000 rands depreciation per annum. Now let us check if for how many months must we account for the depreciation. Remember, this equipment was in the business from the 1st of September 2003, and we are doing the contract account, and now we are calculating the carrying value on the 28th of February. Carrying value on the 28th of February. That means is from September until February, which is equal to 6 months. So now if this is 6 months, therefore now we have to say September, October, November, December, January, February. That is equal to 6 months. Then we have to say divide by 6 months. Then when we divide by 6 months, we have to multiply, we have to multiply by 6 over 12. We say times by 6 months out of the 12 months. Then this will give us 30,000. This will give us 30,000 for 6 months, which is depreciation for 6 months. So now this is depreciation for 6 months that we are looking for. Therefore now we can be able to say cost less accumulated depreciation, that will give us carrying value. Therefore our carrying value will be equal to cost of 400,000 less 30,000 rands, and this will give us 370,000 rands. So now this is the carrying value that they are looking for here with the question mark. So now this will be an amount of 370,000. So now we go and we record in the contract account on the credit side under the carry down, and under carry down we say machinery 370,000. 370,000 rands. So now we continue with the balances that we are busy with. Now when it comes to balances, we have done the material, we have done the machine, and we are told that there is wage prepaid. And remember, for every expense that you pay before time, then that expense becomes an asset, and we know that the balance of the prepaid expense or the balance carried down, remember we are busy with these are the balances, these are the balances carried down, balance CD carried down. So now when we record, we need to record from the perception of the carry down, and we know that the balance carried down, let us say in the case of the material, we know that the balance carried down of this asset, which is material, it will be on the credit side because it's an asset, and balance carried down of an asset will be on the credit side. So now same applies with this case, the balance carried down of an asset will be on the credit side. And again, this is wages prepaid, then the balance of the wages prepaid, balance carried down, will be on the credit side. So now that is why the wages will also be recorded as 1,000 on the credit side. And beside, remember, the wages that we see here, 74,000, they include 1,000, and that 1,000 is not for this period. So now if means the debit side of the contract account is overstated by 1,000, therefore now it must be reduced by prepaid wages of 1,000 on the credit side. That is why we record 1,000 on the credit side, and the contract entry becomes prepaid wages. Prepaid wages. So now that will be the balance carried down for prepaid wages, balance carried down. Then after we continue again in the same note. Then now we have cost of work completed but not yet certified, 10,520. So now this is the work that was completed, but the architecture or the land surveyor or the evaluator of this contract did not come to certify the work. Not to say the work is not of quality, but it's not yet certified. So now we have to take it out of the contract account, and we record that as an asset by the end of the period, because this is an asset, this is the cost of the work that was unsatisfied or work not yet certified. So now we record that also as a balance, because it will be recorded in the balance sheet, and the entry for that will be uncertified work. Uncertified work, and the uncertified work is 10,520. 10,520 uncertified work. 10,520 is uncertified work. 10,520. Just complete that. 10,520. That is work not certified. So now work not certified is recorded on the credit side of the contract account. So now we have accounted for everything, and the only thing that we need to record on the debit side now is the overheads absorbed. Remember, I told you that our overheads are 25%. At 25% of the cost of the material used. So now we said we need to know the material that was used. In order for us to know, we need to say purchases. The material that was purchased amounted to 237,320. Then after we are aware of the fact that there was transfer of material. Transfer from storage, and the transfer of the material from the storage, we have recorded that as where is the transfer? 54,100. Then we say plus 54,100. Then we subtract the transfer to storage. We transferred some material back to the storage, and the material that was transferred back to the storage amounted to 3,230. So now we subtract that 3,230. Then we also had material that was transferred to another contract. Transfer to contract, and that amounted to 5,590. Then there was a balance at the end of the period. Balance carried down or closing balance, and that balance amounted to 7,000. So now we subtract all those to get to the material that was used. So now that will mean we have to say 237,320 plus 54,100 less 3230 less 5590 less 7,000. Then this gives us 275,600. This gives us 275,600. This is the material used. So now we do have material used. Then we say multiply this by 25%, where we say multiply it by 25% times by 25 over 100, and this gives us 68,900, and this will be our overheads. This will be our overheads, which is 25% of the material used. Then we record that as overheads. 68,900 are my overheads. And from here now, I can calculate the total for this contract, total of all the expenses, and also record at the same time the value of the work that was certified. So now let me calculate the total of all the debit side, and in doing so we start from the beginning. We say 400,000 plus 4,700 plus 64,800 plus 237,320 plus 54,100 plus 9,500 plus 74,000 plus 16,000 plus 68,900. That gives me 929,320. 929,320. 929,320. Then from here now we have to subtract all the credit side. Then we say less the credit side, and our credit side starts with, we say less 3230 less 5590 less 2,000 less 7,000 less 370,000 less 1,000 less 10,520, and this gives me 529,980. This gives me 529,000. Let me check it again. 529,980, and this will be the balance carried down, which is the cost of sales. Balance carried down, which is the cost of sales. The cost of the work that we have done is this amount, 529,980, the cost of sales. So now from here we continue and we record now the price of the contract. Remember, so not the price of the contract, but the value of the work that was completed, the value of the work that was certified. we record that on the credit side because this is what we're supposed to receive for the work that we have completed and certified. Work certified by the architect, sales value is 630,000 rands. The value of the work certified is more like the selling price of the cost of the work that we have completed, because this is the work that we have completed and the cost of the work that we have completed is this amount. And in that cost now, the client promised to give us the amount of 630,000 rands. So now this is the price or the selling price of the work that is certified. However, the cost of the work that is certified is this amount. So now, meaning that we have to record now the selling price, and the selling price will be recorded on the credit side as 630,000 rands. 630,000 rands. And the contra entry will be the Kadima Shops Close Corporation. That is the price or the value of the work that is certified. Remember now, in this case, we have to bring the cost of sales, because we know from accounting perspective that cost of sales are recorded on the debit side. So now we have to bring that cost of sales on the debit side so that we are able to say cost of sales versus the selling price to determine either have we made a profit or a loss. So now we say balance brought down is no longer carried down now. Balance brought down 529,980. 529,980. We are bringing the cost of sales to the debit side. So now this is the cost of sales and this is the selling price. This is the cost of sales and this is the selling price. Cost of sales and the selling price. So now we have recorded the cost of sales and the selling price all together. So now we have to compare the selling price and the cost price to determine either have we made a profit or a loss on this work that is still in progress. So now we say, okay, cost of sales is 529 and the selling price is 630. So now obviously we have made a profit of 100,020. So now that is our profit. If you want, you can say 630,000 rands. 630,000 rands less 529,980. That is the profit that we have made. Meaning the profit will have to appear on the debit side where we say profit slash or a loss. And that will be 100,000 and or 10,020. So now we have this profit. Then after we have completed the profit, and we can just draw the line here, and when we draw the line we just calculate the total, and the total will obviously be 630,000 rands. 630,000 rands. Then we bring the profit or the sales value of the work certified, which is 630,000 rands, the sales value of the work certified. Then now after you have done with this, you immediately have to bring all the balances. Bring the balance carried down to become balances brought down. All the balances carried down to be balances brought down. So now this is our mission, to take all this balance and we bring them down to the debit side. So now we have balance brought down. Balance brought down for material. I think the first one is material of 7,000. And balance brought down for machinery 370,000 rands. Then after we have balance brought down for prepaid wages. Balance brought down for prepaid wages. Which is an amount of 8,000 rand. Then after we have uncertified work. balance brought down uncertified work. Then uncertified work balance was 10,520. 10,520. Remember, material at the end of the year is an asset. Machinery carrying value, obviously this is an asset. Prepaid expense at the end of the year, obviously is an asset. Uncertified work is still an asset to us. We don't owe it to no one. We have done it. This work is for us. At the end of the day, the client will pay us for the work that we have done. So now all these are assets. Then after we have recorded this, now we have to go to the second stage where we have to record all this. We have recorded the ledger account for the client now. And in recording the ledger account, we have to record the debtors account. In other words, the debtors account, which is Katima Shops Close Corporation. We say debtor. You don't have to say debtor. Sometimes they will say debtor, but sometimes they'll just write the name of the client. Katima Shops Close Corporation. Then we know that Katima is the debtor to us. Then on the debit side, we know that this debtor owes us the value of the work that was certified, because some work was certified and the value of the work that was certified was the money that the client owed us. So now the client owed us this amount because the 630,000 was the value of the work that was certified, meaning it was complete, it was up to standard, everything was perfect according to the architect who did the evaluation. So now the minute the architect evaluate and satisfied and say, okay, the price for this work is this amount, then that means that amount becomes due to us as the company or the contractor. So now the minute it is due to us, therefore now our client will immediately owe us the 630,000, and the contract entry will be contract account, which is the same as that which come from the contract account, because in the contract account we recorded 630,000 rands on the credit side, which was the sales value of the work that was certified, which it could have been recorded as a debtor because the client was owing us this amount. Then now after the client owed us this amount, he only paid us part of this amount, not all of it. And whenever the client pays, then we expect that the debtor will have to decrease on the credit side. So now the amount that was received was less than what was supposed to be received. And the amount that was received from Katima Close Corporation was 560,000 rands, meaning by the end of the year, Katima Close Corporation still owes us some part. Therefore now, or some money, then this will be 560,000 rands. That means our debtor by the end of the year, or the amount of the debtors, or the amount that our client owes us as a debtor by the end of the year, will be the difference between what he owed us on the amount that was certified and how much he paid us. Therefore now the difference, which is called a retention amount, will be recorded as the difference, which is the balance, and also an asset. So now we record that as a balance carry down of the difference between the two, which is 630,000 rands minus 560,000 rands, and that will be 70,000 rands, and that 70,000 rands will be the data that will be recorded in the statement of financial position by the end of the year. And we have to bring this balance on the debit side, where we have the balance brought down as 70,000 rands. So now we have recorded that. So now immediately after that has been done, we have completed now all that was necessary so far. Then we go to the last part, which is the balance sheet or the statement of financial position. Balance sheet as at 28th of February. Balance sheet as at 28th of February. Balance sheet at 28th of February in the year 2004. And we record the assets, and we only have assets. And under assets we have non-current, assets. Under non-current assets we have property, plant and equipment. Property, plant and equipment, we know PPE, or plant and equipment, and our plant and equipment amounted to 370,000. It must be plant and equipment because plant and equipment. $370,000. Then after we go to current assets. Under current assets we have quite a number of assets. Inventory of material. We have inventory in terms of material on site. Inventory in terms of material on site, and that was 7,000 rands. We also had another form of inventory, and that inventory, remember we are referring now to these balances. These are the balances that we are bringing down. I'm talking about all these balances now. This is what we are dealing with, and all these are assets. We have seen that these are the balances that will appear in your statement of financial position, because this is an asset. It's a machine inventory. Inventory of material is an asset. Carrying amount of the machine is an asset. Prepaid wage is an asset. Uncertified work, which is work not yet certified, but we have completed it. It is the work. It is an asset to us because this work can be sold and we can make money out of this work that is not yet certified. So now it does have the value, and the minute it does have the value and it can lead to future economic benefits, therefore now that is an asset and we have control over it. So now we also have to record that inventory in terms of, we have inventory in terms of long-term contract. We call it long-term contract. Long-term contract. The inventory in terms of long-term contract is the 10,520, because the contract is bit long. So now by the end of the year there was work that was not certified yet it was completed because of the period of the contract. It's still a long-term contract. So now uncertified work in the statement of financial position, we don't record and write it as uncertified work, but we record it long-term contract. So now that is the description for the work that is uncertified when it's recorded in the statement of financial position. So now that will be a long-term contract, 10,520. Then after we go to the next one, which is a next expense, and the next asset, which is prepaid. And the prepaid wages amounted to 1,000 rand, and we know this is an asset. And we have receivables. Receivables, which is debtors, and that is called a contract debtor. This is the debtor because of the contract, and this amounted to 70,000 rands. This 70,000 rands is this 70,000 rands, the debtor because of the contract, because the client was supposed to give us 630,000 rands, which was the value of the work that was certified, but he only gave us 560,000 rands because of the so-called retention amount. So now the retention amount of 70,000 rands is an asset or a debtor to us, because the client will pay us that amount later on. So now, so far we can recognize that as an asset in the statement of financial position. So now that was it with regard to this exercise. And with that being said, I thank you guys, and I hope you have learned something and understood something this exercise. God bless you.